Good afternoon. Thank you for joining us here at Cutler Investment Group series of webinars. My name is Matthew Patton. I'm the Chief Executive Officer here at Cutler, and I am joined today by Eric Patton out of our Bellevue, Washington office, and Brian Knudsen, a Senior Wealth Advisor in our Seattle office. Today, we're going to be covering the coronavirus explanations, opportunities, and information for today's investors. As a reminder, all of the information we're going to present today, we believe to be accurate as of today. However, if you are watching this on a webinar in the future on a replay, please keep in mind that the data may not be accurate at that point in time. So what are we going to cover today? Asset class reviews. Eric's going to talk to us a little bit about the equity market and what's happening there. And then Brian's going to talk to us about fixed income, what the Fed's doing, and what impact that might have, followed by an economic outlook, a little bit of conversation about what is monetary and fiscal policy. What we show here is Fed and government stimulus as it impacts the economy, and then opportunities for investors. CARES Act highlights, ROTH conversion, something you might want to be thinking about if you do have a ROTH, and then asset reallocation and tax loss harvesting. That also is a little bit about what Cutler could do to help you and what Cutler is doing as part of our investment on your behalf at this point. So we're going to get started, and Eric is going to talk to us a little bit about equity markets. Eric.
Thank you very much, Matt, and thank you everyone for joining us this afternoon. The equity markets hit an all-time high on February 19th. That's almost 2 months ago, and I want to remind everybody that bear markets are measured in months. Bull markets are measured in years, and I think that Wall Street axiom just puts in perspective why we're investors. And this bear market has been a little bit different for everyone because in past bear markets, people could look the other way and maybe ignore the news, go about their daily lives. And today, that has changed. Everybody has their social calendar has changed, their obligations have changed. And so we're all watching the pandemic news day by day and minute by minute, as well as the stock market minute by minute in many cases. And that changes the emotional reaction a lot of people have to a sell-off into a market. Hopefully today we can put some of that in perspective for you and give you confidence about your investment plan going forward. But this chart shows that the recession is already here. This is the Bloomberg Economics Probability Index of a recession. And you can see it's currently at 100%. The reason why that's unusual is a recession is 2 consecutive quarters of GDP contraction. We very likely had a contraction in the first quarter. The current estimates are minus 2.3% of GDP growth. And in the second quarter, this chart is telling us we're definitely going to have a contraction. JP Morgan came out late last week and said it could be a contraction of as much as 40%. They also felt that unemployment could go as high as 20. Now, is 20% unemployment realistic? Is that something that our economy could actually go through? Well, let's look at this next chart. And Matt, if you could forward that, there we go. This shows unemployment insurance claims since 1967 through last week. And as you can see, throughout the last 53 years, we haven't even approached 1 million claims. The highest that we achieved was in 1983. We had about a 10.3% unemployment rate. All of those shaded regions are recessions that we've had throughout that 53 years. Again, none of them close to what we've seen in the last month or so. We had 6.8 million claims on March 28th, another 6.6 on April 4th. Today, we're at about 16.8 million Americans who have filed for uninsurance. These numbers are just unprecedented numbers, nothing like we have seen. 20% does not seem unrealistic based on the current trends that we've seen in the economy. We're likely at 14% year to date, or as we speak. So we're roughly 4% higher than where we have been at any point in the past. So on this next slide, you can see that we've had a wild ride. Stocks have had unprecedented volatility. And volatility we haven't seen since the Great Depression. What this chart shows is the 25-day average of the absolute return of the stock market. So what we have averaged is 4.78, either up or down every day for the last 25 years. We haven't seen volatility like that since 1929. 10 years ago, in the financial crisis, we thought we had seen volatility that was really once in a lifetime type of volatility. Well, here we are 10 years later, and we haven't, and we've exceeded that over the last 25 days. 1,000 point swings on the Dow have become commonplace. Even last week, and this was the headline that everyone went into Easter weekend with, last week was the best S&P 500 return in the last 45 years. And what I think is important for investors to be aware of is, as we look back through last night, the S&P was only down 1.1% in the last 12 months. I want to repeat that because I think it's such an important statistic to keep things in perspective. For the last 12 months, through last night, the S&P 500 was only down 1.1%. Now, we are significantly off of our highs. We're also significantly off of our lows. Much of that has to do with the strength of the returns that we witnessed last year. But given all this volatility and what we've gone through, how did investors respond? What were people doing in their portfolios? And the answer is really not a lot. This next slide will show us, there we go. This next slide will show us what investor sentiment was over the March 17th through 19th period, right around St. Patrick's Day, as well as early April. Now, March 17th through 19th is right in the midst of the start of this crisis, so sentiment was a little worse. But you can see about a third of investors felt that this was a buying opportunity. Those might have been people with cash on the sidelines or investors that had maybe a more conservative portfolio than they wanted to be in for various reasons, and they're looking at this as a buying opportunity. The vast majority of investors, over 50% in both cases, felt that this was an opportunity to do nothing. And I think that's great. I think it means that investors have learned a lot over the various crises that we have. Today's investors have lived through Black Monday in 1987, the tech bubble in 2001, the financial crisis in 2008, and now the coronavirus in 2020. It seems as every 10 years or so, we've had a once-in-a-lifetime sell-off. And I think a lot of investors keep that long-term approach now, and we've been trained to wait until the dust settles and then make changes to our portfolios. At the bottom of this chart, you see investors who felt that this was a time to decrease their stock holdings. This is what every financial advisor in America has been talking with their clients about, trying to prevent them from doing long-term damage to their nest egg. Selling at a time when the market has bottomed is not the right investment strategy for most people. This chart shows why. The cost of market timing. And as you can see, if you were invested in the S&P 500, historically you'd get about 9.3%. If you missed the 10 best days, you gave up nearly a third of that return. So you would return 6.8%. What I think is worth noting is that some of those best days, in fact, many of those best days, occurred during bear markets. We saw this in our current bear market. In the second half of March, 3 of the biggest up days in the last 90 years, including the best day since 1933, happened. On March 24th, the Dow Jones Industrial Average was up 11.3% alone on that day. Now imagine if on March 23rd, you had made a decision to change your allocation and you were not fully invested at the opening on March 24th. You could have done significant damage to your portfolio by a timing decision that really just was an unfortunate timing event. So why did the markets rally? Why are we up 25% from the March lows? Well, there are many explanations why. There's not one single reason as to why stock markets go up or down. But I think this chart is perhaps the largest explanation or the biggest reason. Matt will discuss another one with the CARES Act when he discusses the federal government's response later in the presentation. But on the bottom right of this slide, you can see the Federal Reserve's balance sheet. This is in $1 trillion. And, you know, the first thing that jumps out to you is in 2008, we had a very stable balance sheet up until the point of the Great Financial Crisis. Ben Bernanke was the Fed chair, and he was a student of the Great Depression and understood that the Fed's reaction in 1929, draining liquidity from the system, was exactly the opposite of what our economy needed. Instead, what we needed was a stimulus, was an injection of money, and he injected $1 trillion in a very short period of time into our economy to save us from catastrophic collapse. Well, look at what the current Fed chair, Jerome Powell, has done over this year. We've increased over $2 trillion on the Fed's balance sheet. And the reason why that matters to equity market investors is shown on the top left of this slide. On the top left, I'll just sum it up by saying there's a positive correlation between the Fed's balance sheet and stock prices. As the Fed injects money into the economy, stocks historically have reacted positively to that. Well, could this keep going? And this chart shows that it very well could. Our Federal Reserve is the green line on the bottom. And this chart shows the central bank asset holdings as a percentage of GDP. And yes, they are up significantly this year. Part of that is GDP is contracting and the Fed's balance sheet is growing. But look at our peers around the globe. The ECB is up over 40%. Japan, which has been an experiment in monetary policy for quite some time, is up over 100% as a percentage of their GDP. And yet they have yet to really see significant inflation. These are unprecedented times, but our Fed chair has made it clear that the Fed is going to do what it takes to support the economy and to support stock prices. This is part of the reason why Goldman Sachs came out today and said they felt the bottom in stock prices was in. The bottom typically occurs 5 months before the end of a recession. And, if you're looking forward, that means they're forecasting a midsummer return to growth. I think given the nature of the crisis that we find ourselves in, that might be a realistic possibility. We're not calling a bottom. We're not trying to pick the top or the bottom of the stock market, but we definitely have some flexibility in what we can do with client portfolios right now. I want to talk about opportunities and really put them in context of the Cutler Equity Fund, which is our actively managed fund here at Cutler. We look at high quality companies that pay dividends. And you could look at the stock market today and say small cap stocks are off 20% from 20% year to date. Large cap stocks are down only 13% year to date. Maybe from an asset allocation standpoint, I should be buying some of those riskier stocks, some of those riskier asset classes. And I don't think that's the right move. What I think investors should be doing is looking for blue chip stocks that are on sale. Yes, there are certain sectors of the economy that have been hurt very hard, travel, retail, the energy sector. But there are other sectors of the economy that are more stable. Look for those high quality companies that are in those stable sectors of the economy that are selling off maybe 20, 30, 40%. This is a great opportunity to buy those companies, to really look for discounts out there in the marketplace. Most of these companies, I got a client question that said, what about dividends? Are companies slashing their dividends? Is my portfolio income going to be lower? Well, most of these companies are maintaining their dividends. If you look at the high quality dividend paying companies outside of a few select sectors, we haven't seen dividend cuts. So I think this is the opportunity. Looking for those types of companies is the opportunity out there right now. And that's where I would be focused as an investor. And now, as exciting as the equity markets have been, the fixed income markets have also been exciting. I'm going to turn it over to Brian, who's going to talk about fixed income here for a few minutes. Brian, take it away.
All right. Thank you, Eric. Hello, everyone. Excuse me. The terms exciting and bonds don't always go together, but in this time period, they really have. So on this chart here, what this is showing us is What happened in the bond market, which sometimes just gets thought of as that safe part of the portfolio that's sort of boring, but there are really thousands upon thousands of bond offerings and many different subtypes of bonds out there. This chart shows the range of returns from the market high, the stock market high of February 20th through the end of the quarter. And I'll just preface that by saying, for some of you out there who might have thought that your bonds were protecting you during that rampant downturn when stocks turned negative and we found out that essentially 20% of our workforce, 15% are likely going to be out of work for some time now, we thought that there would be some value to the defensive nature of bonds. Well, for the 1 month period, starting February 20th until March 20th, these different types of investments were negative. Aggregate bonds, -5, stock, -28, gold was -10, Bitcoin -40, and oil -50%. None of them added value. What happened toward the end of the quarter that helped this dispersion of returns we see here? That's when the Fed stepped in. That's when the CARES Act stepped in. We started to see some separation. On this chart specifically, just look at the most interesting ones are the far left and the far right. The far left is the high yield index. That is going to be your junk bonds, your less stable, your riskier holdings. In this time period, for 6 weeks, that index was down 14% in total return. The average yield to worst, the average lowest amount of yield that you would expect to get if you got paid out in full, jumped up to 9.5%. It had been about 5%. Conversely, on the far right-hand side, the flight to safety wasn't just a flight to bonds, it was a flight inside of bonds. The Treasury index had a total return of 5.5%, despite having a yield of only 0.6. If you think about that, that doesn't make a lot of rational sense, because most of my return, historically about 90% or so of my return in bonds, should come from my yield. Essentially what happened here was I got 500 basis points of extra return out of just price change. That shows me just what a panic we were in and just how extreme that situation had gotten. And that shows that, not a lot of rational thought going on at that time. So we can go on to the next slide, please. Nice control. Okay, so what did we see? That flight down, the flight out of stock, that wasn't just out of stock. It was out of anything that was determined to have too much risk. What is too much risk? It's all in the eye of the beholder. But anything that wasn't treasuries or cash started to see some drop in price. Some of it extreme, some of it not so much. Then once the Fed stepped in, we started to see some normalization. The aggregate bond index is an interesting indicator because so much of it is in treasury. If you think about stocks, if you own the S&P 500 index fund, the largest companies in that index are going to be ones that are determined to be the most valuable. They have the most interest from buyers. You have your Amazons and your Googles and so on. Those are your trillion-dollar companies or close to it. In the bond world, it doesn't matter whether or not people want to own those bonds. If they have been issued, they will be part of that aggregate index. So the Treasury have climbed as the Fed, as the Treasury starts to distribute more and more and more bonds, as we saw from the slide several back that Eric noted. That means that the amount of bonds, the amount of treasuries inside the bond index keeps growing. It is just under half of the index right now, up from 40%. A decade ago, up from about a third 2 decades ago. That part of the index just keeps growing and growing. What happened in some other areas? Corporate bonds got to the point where they had at one point, year to date, about a -12% total return. These are not fly-by-night companies. This is Apple has issued bonds, and GE has issued bonds, and many others. Lots of banks issued bonds. But there was just an assumption, again, right or wrong, and it was more wrong than right, that these companies have all of a sudden become exponentially more risky than they had been before. What happened? Once again, they started to normalize. We started to see some price increase. On the junk bond side, and keep in mind, junk is just anything that is rated under BBB. There are some really high-quality companies, once again, that have been dropped down into that category. If you are a junk bond, you started to see significant drops. That was on the slide before. We saw a double-digit drop just in that 6-week period, let alone the whole quarter for that area. There's been some rampant increase in prices there, but do keep in mind that does, as the name would denote and as the rating would denote, there is much higher default risk there. This dovetails together with that significant drop in oil price that we saw, somewhat due to expectations for less demand, somewhat due to a fight going on between some OPEC members, where the energy sector collectively makes up a significant portion of junk bonds. That has gotten a lot of attention and scrutiny. My take on it is I think some of the corporate bonds that are not part of that world that got the baby with the bathwater, we saw some drop. How do we perceive bonds here? How do we construct our bond portfolio? We would prefer to be in some lower volatility, shorter duration positions. We don't see a lot of upside going beyond, let's say, 3 to 5 years, maybe a very rare exception. Why? Because of that treasury note that I stated on the previous slide. I just can't in good conscience tell someone that it's a good idea to own something that has a 0.5% of yield and yet had a 5.5% return in 6 weeks. That's just untenable. We would rather take a modest amount of credit risk over extending your duration. Okay, so directly tied to both stocks and to bonds is interest rate. The Fed gets a lot of attention these days. It has for some time now, but especially these days, where, as Eric noted, all of us are at home more often than we used to be, and you can see a lot of headlines, right, wrong, or indifferent. Here's the history of what the Fed has done for the short-term rate that they have control over, which then helps to drive other rates. Way back in about 2005, when this slide starts, we were at 1%. We have been coming off of the double hurt of the tech bubble and then the terrible events in New York. There was a series of rate cuts at that point. Then we started to see some climb. We got back to the point, many of you probably remember the good old days when your money market used to pay you probably 5.5 to 6%. Then we got to the point of the Great Recession in 2008, 2009. We started to see a series of cuts. But what's important here is it was a longer, shallower series of cuts, 50 basis points, 25, 25, 75, 50, and we got down to the point where we were at 0. But if you look at that series of cuts, it happened relatively gradually. It was over multiple months, not multiple weeks. We got to about 0%, stayed there for quite some time. Of course, if my interest rate is 0, it's going to make stocks look much more attractive, especially on a price to earnings ratio. I'm willing to stretch a bit. Then we started to get to the point where inflation was becoming a factor and pulled in the reins. We had 9 quarter-point interest raises to get from 0 to about 2.25. Then we got to 2019, and we started to have some global growth concerns. To more closely match with other markets, we made some cuts. 1, 2, 3, 25 basis point cuts. Then what happened after that? Coronavirus reared its ugly head, 50-point cut and a 100-point cut. What's especially important about that last one that happened on March 15th is that was a bigger single cut than we had during any point in the crisis. Everything has been it's been shrunk down. Everything's been sped up to the point where you cannot be gradual anymore. When you have automated trading and such, you need to keep up. The Fed decided we're going to go to 0. And that is what they have done. And they have said that they're going to keep it there for as long as necessary. Once again, multiple reasons, keep liquidity going and so on. So what does that mean for upside and downside of that series of moves? Obviously, when you're at 0% on the short-term rate, that's going to ripple through to things like money market, things like bond rates, and that's going to make maybe some older bonds look more attractive, et cetera. As far as an opportunity set, I get many questions, and I'm sure many of you out there have either asked someone or thought about it, about what you should do with your home mortgage. Home mortgage rates are lower. They have come down. However, keep in mind, it doesn't necessarily mean that pursuing a new refinance or a new situation for your loan is the best thing to do. The first reason why is there's a significant backlog of activity. Before coronavirus, or let's think of it like this, in the interim period, after the rate cuts of last year, that series of 3 25 basis point cuts, and before coronavirus became as widely prevalent as it is now, there was an interest in refinance activity. Lots of banks out there were really advertising heavily. What happened was they got a huge influx of requests and things, and it started to bog down their system. The second part of it now, and there's good articles on this today, is that many banks are now hedging their downside against the possibility that with this massive increase in unemployment, even if it is short term, it could very likely lead to an increase in either delayed payments and or default. So what's going to happen there? They're going to bump up rates a bit to try to protect their downside. On a practical level, I ran one example, and this could be helpful for those of you out there thinking about whether to refinance. If you have a 30-year product right now and you are 10 years in, which many of us are, if we got a mortgage 10 years ago, 5 years ago, whatever it might be, you are already fairly deep into your loan product. I ran this example on a $250,000 mortgage. It said if I'm 10 years in at a 4.25% rate, I'm paying about $1,550 a month. I have about $120,000 of interest remaining to be paid, which is really what matters to me, because that's money that I'm paying for the privilege of having this loan product. If I were to refinance today on a new 30-year product at a 3.5% rate, so my rate went from 4.25% to 3.5% in this hypothetical, my payment goes down to $1,122. So it went from $1,500 to about $1,100. That's great. However, the amount of interest that I'm going to pay over the period of this loan just went up by over $30,000. It went from $120,000 to $150,000. So that might still be okay for me, but it might not. Right? It's not necessarily the best deal. On the flip side, or another alternative is I could go and look at a 15-year product, and there are 15-year loans out there right now at 3.25% or so. I will have a much lower total amount of interest paid, but as always, there's a catch. My monthly payment is going to be significantly higher. In this scenario, about $300 a month, every single month, higher than it would have been otherwise. So the point of this is, just because rates are lower doesn't mean your situation would call for a refinance. Don't think that it's automatically a great deal for you. One thing that can be a good deal, and the last bullet on here gives you some examples. If you do have other outstanding debt, credit cards, you know what those are at, 15, 20, 25%. You might have student loans. You might have some other things out there that are sort of lingering. If you were to look at something like a home equity line of credit, which I looked at today, there are multiple very good banks out there and credit unions that have opportunities in the 3.5% to 4.5% rate. It's going to depend on how much you plan to use, how long you want to have that product available, your credit rating, obviously. But something like that can add more value immediately than a mortgage might in many situations. If you have some of those other outstanding debts out there, they're not going to lower rates for you. You have to go out and pursue it. This could be a good chance to go and take advantage of that. And with that, I will hand it over to Matt to talk about the CARES Act.
All right. Thank you, Brian. So the CARES Act, something that I think many of you have already heard about. It is $2.2 trillion, and you don't get $2.2 trillion out there without some press. So Brian already talked about, and I think actually Eric's slide said it, $2 trillion or so added to the Fed's balance sheet. Now we've got the government adding $2.2 trillion from Congress, a federal stimulus. So we've seen both monetary policy from the Fed at $2 trillion and fiscal policy from the government at $2 trillion. So we have an incredible amount of liquidity that's gone into the economy at this point that is going to have some serious impact on how this economy is going to keep going. If in 2008 adding $1 billion helped Ben Bernanke save the economy, you can imagine what the $4 trillion and counting is going to do for this economy going forward. And yes, part of this is we don't know all of the implications that's going to happen in terms of historic levels of unemployment, but we do know that there is a lot of money, a lot of liquidity, and a lot of opportunity right now for small businesses in particular, as we'll talk about in the next slide. So what does the CARES Act mean for you? First and foremost, taxes are delayed. You don't have to pay your taxes. As probably every bullet I put on here, there are some caveats. The first one is you do have to pay it. They're not going to let you get off the hook, but you don't have to pay it until July 15th. The second is if you want to pay your taxes sooner, or rather, if you want to get your tax return filed sooner and get your money back, you still can. So they're still cashing refunds. You can get your money. However, if you want to wait till July 15th, you're able to. The Secure Act, many of you know, passed in December of last year, and that pushed RMD's start dates from 70.5 to 72. Now the CARES Act, just 4 months later, is kind of unraveling that, or maybe I should say just buying you another year. RMDs for all participants are not required in 2020. So whether you're 70.5 or whether you're 72 or 80, you do not have to do an RMD this year. If you've already done one in the last 60 days and you want to put that money back into your IRA, you can do that. You need to talk to your Cutler advisor about how to get that money back in. So RMDs can come back in if that's what you want to get done. Private insurance plans required to cover COVID treatments and testing must be free. And maybe some of you have already seen it, but checks have started to be issued already if you file your returns electronically and get your refunds deposited electronically into your account. Now, obviously, caveats on this one as well. Your eligibility to get money from the government, 99,000 single, 198,000 joint. So if you are below those, you can expect to start seeing money come in this week. I believe it's next week we're going to start seeing actual checks going as well. So you've got some good news here in terms of the money coming in. So student loans. Now this is an interesting one. It might not apply to many of you on the phone call, or at least you might not think it does. First off, if you're an employer or you have a kid or grandkid with significant student loans, this actually might apply to you. Here's an opportunity as part of the CARES Act for you to help those individuals with up to $5,250 and have it not count for employee income. If you've got an employee who's working for you with a high level of student loan debt load, you can convert part of their income into this repayment, and they're not going to have it count as income at all. So you still get the deduction, and they don't have income counting towards them. It is almost a win-win. In fact, I'm not sure what else how else you might be able to qualify it. So that is the CARES Act. We're going to go down now to the next screen and talk about Payroll Protection Plan, another interesting one. We're going to focus on the small business loan section of the Payroll Protection Plan, since that really is the most important to most of our clients. Right now, and if you haven't really followed it and trying to figure out what it is, the Payroll Protection Plan is effectively the government's attempt to keep small businesses with their employees on their payroll, right? Don't cut your payroll, keep your employees on, we'll help you pay them. They've already allocated of that $2.2 trillion, $377 billion, specifically small businesses. There's already discussions beginning for an additional $250 billion to be added on to that. So this package has been very successful. It has had a lot of press, and part of the reason is it's 100% guaranteed by the federal government. And 75% of the loans that are used towards salary, if 75% of the loans are used towards salary, you can use the remainder of your loan amount from operating expenses, rents, and utilities to have all of your debt forgiven. So you're borrowing money, it's backed by the government, and as long as you keep your employees on, keep paying them, and making sure that the business of America keeps going, you get that money directly forgiven by the federal government. Corporations were able to apply April 3rd. Self-employed can now apply as well. So if you are a self-employed small business owner, whether it is a hairdresser or a dentist or any of the other self-employed that maybe don't have a corporation around you, you can also now apply for the Payroll Protection Plan stimulus money. Now, on the other hand, something to consider that's come about with the CARES Act is unemployment compensation is increased. Average in the U.S. is about $380 a week of unemployment payment. This was a very debated provision in the Senate, and actually was what held it up a couple of weeks ago from getting passed, was the concern that they've now added on to that 380 an additional 600, meaning the average American unemployment recipient is now getting nearly $1,000 a week, or, to help you with the very obvious math, a $52,000 paycheck if annualized. Now, they can only get that for 4 months, but our point of bringing this up is, what does the recovery look like when we have employees that don't want to go back to a job that paid them $500 or $700? Well, what if the job even paid them $1,000 and they can stay home for the same amount of money as they could go to work? Especially if it's an environment where we're not 100% sure whether or not they are going to be safe if they go back to work, or how this is going to play out on the virus side. So we're not sure, and what Cutler's paying attention to is how does this get the economy going again? What's the implications of this, and how do we make sure that these people are motivated to get back to work, and the out of work have an opportunity to get back to work in a safe manner and get the economy going again? Because this is really generous and a terrific opportunity, because a lot of people likely would have lost their homes, had credit card debt they couldn't pay, and probably medical bills they couldn't pay. And this $1,000 or $983 a week on average, this nearly $1,000 a week, is going to allow them to continue to do that. It's going to allow landlords then to get paid rent. It's going to allow the landlord to pay the banks. It's going to do a lot of good for the economy, but there's no way of knowing at this point how that's going to impact our recovery as we go into the summer. So now, Brian, I'm kicking it back to you to talk about Roth conversions under the section of what can people be thinking about to make a difference in their portfolios, and what are some of Cutler's thoughts in doing so. So, Brian, sir, you are back on.
Thank you very much. So as we stated at the beginning, one of the things that we want to look at in this environment are some opportunities. We know downside protection and things like that are great in portfolios, but let's look at some things that can help for the long term. One of those can be Roth conversion. What is this? This is where you have a pre-tax traditional IRA account, an account that holds positions that you have never been taxed on yet, and you can convert those to a Roth format, where basically that means that you pay tax now on the income that you receive, and then after that point, any growth back to what something might have been worth before the crisis started, and then any future growth and interest/dividends after that are exempt from taxation. What kind of environment would I look for a situation like this? I would like one with low income taxes by historical standards. I would like one with lower asset values, so that I am paying less on my converted amount. We happen to be in an environment right now where both of those have come together. With stocks sharply down, what you can do is take some very good positions that used to be worth, say, $100, just hypothetically, now they're worth $80. You make the conversion. What is important here is, unlike your required minimum distributions, this is not based on the year-end value. It's not even based on the month-end value. It's based on the value on the day that you actually make the conversion. The process of this is, think of it like you're receiving a distribution to yourself and then reconstituting that to a Roth format. And the really important factor there is income is paid on the time of conversion. So that can be done at a depressed market value. And I will show you an example. So John Doe has a traditional IRA, a pre-tax IRA with positions, as I said before, have not been taxed at all yet. For simplicity, we're going to say he has one fund. It doesn't need to be just one fund or one holding, one stock, one anything. It can be a blend of things. But for simplicity here, we're going to say John has fund ABC. Back in January, way back 3 months ago, it was worth $50,000. That value has dropped down to, let's say, $40,000. Pretty realistic given where we are right now. And I talked to John, or his CPA talked to John and said, John, it looks like your income for this year, for your household, is going to be about what it was last year or less, or some amount that's palatable to say that we can add some income to that total without pushing you up into a significantly higher tax bracket. Okay, so what does he do? John decides then to reconstitute, to convert that position over to a Roth format. He will then have $40,000 of additional income reflected on his taxes. And keep in mind, unlike your wages, there is no tax withheld at the time when you make this conversion. Right? You are going to make this conversion. You're going to want to pay that tax out of existing holdings, out of existing cash, I should say. You do not want to necessarily deplete further down the value of this distribution. You want to get as much bang for your buck here. So if I have some cash on the sideline, or John does in this case, and John has an income situation where this isn't going to make his revised income total uncomfortable, he can make this conversion, bring it into his Roth IRA, that $40,000 position in Fund ABC. It gets back at some point in the future to $50,000. After that, it keeps going and it keeps going. In the future, what is the upside to John? The first one is that he has converted to an after-tax format where there's no tax due on that distribution. The second part is he is no longer subject to required minimum distributions for any of the money that he has converted. Roth IRAs are specifically withheld from RMD calculations because you've already paid the tax. You don't need to pay it again. And also, there is some benefit on bequest and things for your estate that we can certainly get into if anyone wants to have a one-on-one conversation. The important factors again here are, what is your income situation for the year? What would it look like if you were to take an additional amount of income? And what is the upside for you going forward? It's going to be that you do not owe tax on that amount that you have converted. But please do be aware, you will want to have cash available. Like if, for example, here, if John did, excuse me, a $40,000 reconstitution, a conversion, he's probably going to owe around $10,000 of tax. That's a 25% bracket. That's, you know, kind of middle ground for where we are right now. You're going to want to make sure you have that cash available and you do not take it out of your distribution, because then you sort of defeated a lot of the purpose of doing this sort of conversion / reconstitution. So this is a very valuable tool. This is one of those situations where the multiple aspects that would make this advantageous have come together. This is worth having a conversation with your advisor here, whether that's me or someone else, and or with your CPA, to make sure you know how it specifically can work for you. And with that, I will hand it over to Eric to finish this up.
Great. Thank you very much, Brian. And our last topic of the day is going to be reallocating your portfolio as well as tax loss harvesting. And, you know, if you think about being 18.3% off of our February highs and 26% off of our lows, this is a great opportunity to be looking at portfolios and deciding if you're comfortable with your current risk. You're not selling at the bottom. You're also able to take advantage of some of these sell-offs to reallocate your portfolio. One thing we like to talk with clients about is tax loss harvesting, which refers to selling your losses now to take advantage of a lower market. And in any portfolio, you're going to have winners and you're going to have losers. Well, now's a great time to sell some of those losers, perhaps, and rotate them into another security or another position to lock in those gains. There's a few caveats, a few things to be aware of, which we've put in bold here at the bullet points at the bottom. The first one has to do with losses can be carried forward. Certain losses can be carried forward, but gains cannot. So gains you have to recognize in the year that you take the gain, but losses give you optionality. So if you take those losses today, you don't necessarily have to have the gains offsetting, but if the market recovers, if those securities recover before you have a chance to take those losses, you'll never have an opportunity to realize or to take advantage of that asset, which is a tax loss in your account. One thing to be aware of, though, are wash sales. Wash sales have to do with when you sell for a loss, you cannot buy that security back for another 31 days. That means you have two options. One is to leave it in cash. And I talked earlier about the costs for being in cash during a bear market, how you could miss some of those big up days and wouldn't be able to participate fully in the upside of the market. Well, the other option, if you're tax loss harvesting, is to buy a replacement security. The IRS guidance is that the replacement has to be sufficiently dissimilar. So you cannot sell an S&P 500 index fund provided by Invesco and buy an S&P 500 index fund provided by Vanguard. That would likely be disallowed by the IRS. We have internal guideposts that we use for tax loss harvesting. If you'd like to talk with us about what those criteria are, we'd be happy to offline. But please keep in mind that there is no hard and fast guidance from the IRS. It's a lot of guessing from advisors to try to find appropriate replacement securities for a tax loss harvesting approach. And then finally, here in bullet, and this is the last point we'll make today, but don't forget to look at specific tax lots. Oftentimes, investors will look at their statements and say, I have a loss in this particular security or a gain in this particular security, but they may have purchased that security many different times over the past decade or 2 decades. Looking at the lots, you can sell specific lots in your portfolio and recognize just those lots. So you do not have to sell everything out of your portfolio. You can identify which lots of a particular security are most attractive to sell. And with that, Matt, I'll turn it back over to you.
All right. Thank you, everybody, for joining us. Brian and Eric, I appreciate your insight. We have gotten a lot of questions from what has been our first sold-out webinar. We went all the way to the Zoom Max today for how many of you could join us. We're excited that you were able to, and we hope that we were able to provide a little bit of insight as to what's going on in the markets. We will post this to the website by tomorrow, so if you want to forward it to any of your friends and families, please do so. Or if you want to go back and catch some of the points that maybe you did not hear today, it will be available to you. Finally, each of your Cutler advisors has been on this call today. They are ready to answer any questions you may have, or they're ready to send those questions on to one of us to make sure they get addressed. So please don't hesitate to reach out to them. Let them know if there's something else you might want to see as a future webinar, or if you have any questions about today's material. Thank you for calling in to Cutler's webinar on the coronavirus, and thank you for being a client. We appreciate it.